So welcome to First Thursday and the presentation by the Asset Protection Council. Today's presentation is integrating tax planning, asset protection, and estate planning. This is unique. It doesn't happen everywhere. In fact, it doesn't happen most everywhere. It just doesn't happen. My name is Douglas Lodmell, and I'm the founder of the Asset Protection Council and the co-founder and managing partner of Lodmell & Lodmell. We're one of the leading asset protection law firms in the country. We speak all over the country at asset protection conferences, and we created the Asset Protection Council specifically to allow estate planning attorneys and financial advisors and other professionals that are working with high net worth individuals to access the best technology we've been able to come up with to protect assets. Part and parcel with that is obviously doing all the other things once you get a client in the door that say, okay, great, we've protected my assets. What about all these other things? And so today I am very pleased to be introducing as our guest Tom Wheelwright. Tom and I have known each other for 15 years, I think. We've worked together with clients, and Tom is really a leader in the industry of taking the role of the CPA, and if I can say it this way, Tom, expanding it and really making it about how do you get the client not just the tax returns done and the bookkeeping right, but how do you get them on their path to building true wealth. So welcome, Tom. I'm really happy to have you here.
Well, thanks for having me, Doug. It's it's always good being with you and your folks. I mean, we have known each other for, it seems like, forever. So it's great. I'm very excited about your Asset Protection Council. I think this is fantastic.
Yeah, I am as well, and I'm very happy to have you as a member and a contributor. And so, unlike other presentations where I have a slideshow, we're just going to let you take it away, Tom, because I know you've got a whole way that you present what you do and how you do it that I think everybody's going to really appreciate. So I'm gonna hand the wheel to you, and you can just take it away.
Awesome. Well, we're going to make this interactive. So I want to start by asking everyone, and if you can, even type in the, you've got a little question box. If you can type in your answer here. How many of you pay income tax? How many of you pay income tax? Can you type it in or just think about it?
Yeah.
Next question is, how many of you would rather not pay income tax?
These are gimmies, Tom. I mean,
I know it, man. But here's the clincher.
Yeah.
The third question is, how many of you know somebody, client or somebody else, who feels a necessity to cheat in order to reduce their income taxes? You don't have to answer that one.
Yeah.
But I want you to think about that one. Again, I want to thank Doug for inviting me to your group, and we're going to have a great time over the next 45-50 minutes. We're going to kind of think about things a little differently. You know, I grew up, I don't know if you know this, Doug, I grew up in Salt Lake City, Utah.
Oh,
and
yeah.
Growing up in Salt Lake means, pretty much that you're Mormon, right?
Right.
And you're expected when you turn 19 to go on a mission, a 2-year mission.
Yep.
And when I was in high school, we're thinking about our missions, and all my buddies going, oh, I want to go to South America. Everybody's so nice down there, and they're always so successful, and people invite you in, and I'm going, and then we all wait, with bated breath for that letter that comes and says you've been called to go to
right
next place, right?
Yep.
And so all my buddies, they're going South America, Bolivia, Mexico, all these places where people are warm, friendly, fuzzy. They send me to Paris.
Oh, geez.
so at Paris, 2 years, and their 2 years convert 2 people, trying to teach, convert Catholics and atheists to become Mormons.
Right.
And but I'll tell you, I learned a lot about entrepreneurship as a missionary, because I learned about the #1 rule of entrepreneurship, which is rejection, right?
Yes.
And I know everybody on the call here is probably, or most of them, are probably entrepreneurs. I mean, they probably have their own practices, so they're probably entrepreneurs. They understand the idea behind rejection. I think it's important that we understand our clients a little bit. And of course, you and I, we build our businesses, and I find myself entrepreneur first and tax nerd second, for the most part. But really, so that's kind of how I got my start as an entrepreneur. But then, really, for the past 35 years. Really what I've been doing is devoting my life to teaching entrepreneurs how to reduce and eliminate taxes. I have a Bachelor of Arts in Accounting from the University of Utah. I have a Master's of Professional Accounting and Tax from the University of Texas. I was 3 years in the National Tax Department of what is now Ernst Young. Then Ernst & Winnie, back when Ronald Reagan was president and we had the last big tax bill.
Yep.
And while I was there, my primary job was creating courses and teaching courses to the CPAs around the country, tax courses. And then I spent 14 years as an adjunct professor at Arizona State University. I created and taught the multi-state tax class at ASU for 14 years. In the Masters of Tax program. And then for the past it's been 22 years now, I have been building our CPA firm, Provision, really devoted to entrepreneurs and investors and helping them reduce their taxes and building wealth, as you expressed, Doug. And literally all over the world. I actually was in 12 countries. I've been in 12 countries in the last 10 months.
Wow.
And what's really interesting is, I travel around the world, and you go, how does tax travel, right? And everywhere I go, and it doesn't matter if I'm going to Johannesburg, South Africa, or if I'm in Sydney, Australia, or if I'm in San Francisco, California. I've been all those places in the last year. Every time I go, I get the same response. Somebody's going to come up to me by the end of the time I'm there, and usually I'm there for a couple of days, and somebody's going to come up and they go, you know what, this is great. I mean, seriously, I'm in Kyrgyzstan. Some of you may not even know where that is, but
Yes.
Not too far from Russia. Anyway, I'm in Kyrgyzstan, and we spent an entire day with these people. It's 11 o'clock at night. Somebody comes up to me and says, this is really good, Tom, only you can't do that here. And that is kind of become my theme, is you can't do that here, because it doesn't matter where you are. People will say you can't do that here.
Right.
So what I would offer to everybody who's watching today and watching either live or on the recording is, if you would just maybe be open to the idea that you can do that here. Because I'm going to explain a different point of view of the tax law than perhaps has been explained in the past. And the reason we've got my screen here is my staff tells me that I can't. The quickest way to shut me up is take away my marker, so I have to draw. And so I'm going to be drawing while we go here, and hopefully it'll make it a little more interactive so that you feel a little more involved. But if you look at, and now of course we have clients all 50 states. We have clients in 30 countries, 6 continents. And here's what we found as I traveled, because what I find is that every country is really fairly similar. There's really only 4 fundamental ways to earn income. You can earn it as an employee. You can earn it as a specialist or self-employed. That's most of us on the webinar here. You can earn it as a big business owner, or you can earn it as a professional investor. What's interesting is the tax rates associated with how you earn your income. See, in most countries, and it's certainly true in the U.S., in most countries, if you're an employee and you're earning a good income, you're going to pay about 40% tax. Now, if you go to extra school and spend more time at school and get more student loans, and you go from being an employee to being self-employed, you get to raise your tax rate to 60%. And that's typically just because now you're paying both sides of the Social Security tax, right? Now you're paying not just the employer side, you're paying the employee side, right? So your taxes tend to go up for most self-employed people. Business owners, now people can go over to the business side and that actually goes down. Now all of a sudden you're down at 20%, okay, in general, okay? And then if you become a professional investor, you can actually get to zero. So let me give you some examples of this. So recently we had an election, and you recall that one of the candidates was an attorney, and her father was a self-employed person, and she was confronting the other candidate, who's now our president, said, I don't think you've ever paid tax. And if you recall, his response was, that's because I'm smart.
Right.
Well, if you look at this diagram and you look at where they are, you go, okay, this is beginning to make sense. This right here is Hillary Clinton. She, you know, small business specialist, she would expect to pay up to 60% in taxes. But what do we have over here? Over here, we have President Trump, and because he's right here. So for him to pay zero tax actually makes some sense. And if you think back to the previous election, you had a couple of people called Barack Obama, right, and Mitt Romney. And you recall that Romney, his tax return showed he paid about 13%. And Obama, he's a big business owner, right, Bain Capital, and Obama paid about 30%. It was actually pretty low for somebody who's always been an employee. Mm-hmm. Okay, so the perspective, you know, whether you can do it here depends on your perspective as to where you are. Okay, and let me kind of go one step further. The tax law, we think of the tax law as a way to raise revenue for the government, right? That's what we think of. Tax Foundation, which is very well-known think tank in Washington, D.C., they did a study, and their study, they figured out that, this is the entire tax law, that the tax law raised about $2.1 trillion a year in revenue. Okay. On the other hand, if there were no deductions, exemptions, etc., the tax law actually produces $17.1 trillion of tax benefits. So if you put this in perspective, here's your $2.1 trillion, and here's your $17.1 trillion, because it would raise a total of $19.2 trillion then. Okay, when you think about the tax law, there's one line that says all income's taxable unless we say it isn't, right? And then there's one line that says no expenses are deductible unless we say they are. And if you look at the rest of the tax law, it's fundamentally a series of incentives. And it's a series of incentives for particular people. And it's incentives to do what the government wants you to do. So when we talk about tax planning, we're always looking at what does the government want me to do? I'll give you an example. You send your kids to college. Government likes that. They give you a tax credit for it. Okay? You adopt a child. Government likes that. They give you a tax credit. Well, let's take another one. You build low-income housing. Government likes that. They give you a tax credit and depreciation for that. You go drill oil. They give you intangible drilling cost deduction. So if you look at it, the tax law fundamentally is a series of incentives. Okay? So the question is, for our clients is, how do we take most advantage of the incentives for which are available to our clients? Are there things that we can do to help them partner with the government to do what the government wants them to do? So fundamentally what we've discovered is that you can break down the tax incentives into 5 different categories. And this is what I call them. Number 1 is you have deductions. Okay, pretty much everybody is familiar with deductions. Okay, if they're paying money for the Asset Protection Council, that's an expense to their business, and presumably that's a business deduction to everybody on the call here, so that would be a deduction. The next one is what we call conversion, and conversion is where we actually take high taxed income and make it lower taxed income. For example, there's a difference between earned income, which is taxed at the highest rate, and ordinary income, where we don't pay Social Security taxes. There's a difference between ordinary income and capital gain. Okay, there's a difference between passive income and active income. So there's differences on how income is taxed, and one of the things we can do is, with our clients, we can help them convert their income to a lower tax income. And I'm actually going to go through an example of this in just a minute here. Another thing we can do is we can look at tax brackets. Okay, tax brackets, I tell people, Doug, you have kids, right?
I do.
How many kids do you have?
I have 3.
How old are they?
They're 9, 11, and 17.
Okay, so here's the cool thing about kids. Now, if you think back to the 19th century, right? 17th, 18th, 19th century, we were what would be called an agrarian society, right?
Yep.
And so most people were farmers, and so we wanted as many children as possible because they were assets, right? They worked on the farm.
Right.
We either wanted the boy children who could work on the farm, or the girl children who could then marry into somebody else's farm. So one way or another, and produce more farm hands. So we looked at our children as assets. Now we're in the information age, and for most people, their children are not assets. The opposite of asset, of course, we call them a liability. However,
I'm gonna have my kids watch this, Tom, and we'll.
However, let me tell you, Doug, your kids have something that you want, and you can turn your kids from a liability into an asset because they have tax brackets.
Yeah.
And they have all the same tax brackets that you and I have, that everybody in this call has, and that Donald Trump has. And I know some people right now are saying, oh, but there's the kiddie tax. Okay, doesn't matter, okay? They still have tax brackets, and there's opportunities to use other tax brackets. A lot of people use C corporations for their tax brackets. So we have different tax brackets. But another one we have is we have what we call elimination. So that would include tax credits and tax-free income, okay? And then the fifth one, of course, is the one that everybody probably spends most of their time on, and that's deferral, which is actually the one we spend the least amount of time on. But I'm going to talk actually a little bit about some planning strategies that we can use that involve 2 of these. The first one, because they specifically relate to how attorneys, asset protection, estate planning, and attorneys and income tax advisors work together. And that's this one, conversion, and this one, deferral. Okay. Let's look at deferral first, because deferral is something that really I actually, most people, when they're doing income tax planning, that's what they're talking about. And, a lot of they're talking about 401ks and IRAs and stuff like that. And that's, frankly, I think it's a waste of time. I mean, of the tax law, there's 6,000 pages of the tax law, okay? That's just Internal Revenue Code. Of that, there's about 400 pages that relate to deferral, and the other 5,600 pages are how to permanently reduce your taxes. So I've never quite understood why we spend so much time on deferral. However, there is a type of deferral that most estate planners especially are very familiar with. And we call this defer to death, right?
Yep.
So one of the big issues, and I go to the National Tax Conference every year in Washington, D.C., the AICPA, and I go to estate planning conferences and other national conferences, and kind of the big theme there in the last couple of years between the income tax and estate planning has been, all right, so we've got this $11 million exemption, right? Do we get the assets out of the estate? Do we leave them in the estate? because if we leave them in the estate, they get a basis step up, right?
Yeah.
So we defer to death, and then at death, what happens is, right, that tax just disappears, right? Or do we get them out of the estate because we still got this huge estate tax, you know, particularly in some states like Washington, and, you know, even more because they got such a low exemption. But, you know, so this has been the big question. Well, the challenge is that the big challenge we have here is that most of the time the estate planning attorney and the tax accountant are not working together. So if I want to kind of go back to the diagram that I showed earlier, and that's this one right here. And by the way, this is from Robert Kiyosaki's book, Cash Flow Quadrant. He wrote Rich Dad Poor Dad. I'm one of his advisors, and we travel all over together. And so I spent a lot of time with Mr. Kiyosaki. Great teacher, okay? Well, here's one of the things that is really clear. You know, we're in the 60%, let's take the 60% bracket here versus a 20% or a 0% bracket, right? So what do we have to do? Do we have to be a big business to get to 20%? No. Do we have to be a huge professional investor to get to 0%? No, but we have to behave like them, okay? Simple example, and we'll go to the conversion piece here. If you're in the S quadrant and you invest in real estate casually, you have what's called, you're going to, if you leverage it all, you're going to create what we call a passive loss, right? Or a PAL, passive activity loss, which you're not going to be able to use,
right?
Because you're not a real estate professional, okay? But if you behave, you don't have to have a lot of real estate, but if you or your spouse behaves like a professional investor and you meet the 750-hour rule, right? Now all of a sudden, you get those passive losses are now active losses. Because not because you have a lot of real estate, but because you behave like a professional investor, okay? Same thing with a big business. One of the keys is, and this is something that you and I've talked about for years, Doug, is that the reason that the S quadrant tends to pay so much tax is because they behave like amateurs.
Right.
They do, right? They have a Schedule C. They don't have very good books, right? They don't have a good accountant. They don't have a good attorneys. And so basically the tax law and the IRS says, well, if you're going to behave like an amateur, we're going to tax you like an amateur, okay? Because what we'd really like is professionals. So if you can behave like a professional, if you can have your, you know, LLC, and you do a strategy, you have an LLC tax as an S corporation, or you have, you know, your partnership structure set up like professional investors would have or big business owners would have, then we're going to allow you to take advantage of the exact same rules that the big guys have, even if you're small. Because here's one thing that is absolutely a fundamental principle of tax law. Tax law is fair. It is absolutely fair, meaning that if you have two people in the exact same situation, they will get the exact same tax result. Mm-hmm. Okay, so you don't have to. You can have let's say you're a professional investor. You could have a fourplex, right? Or you could have you know, Trump Plaza. Guess what? The numbers may be different, but if you behave the same way, you get the same results, okay, just on a smaller scale, okay? But that's a key, okay? If you don't behave like a professional, you don't get those results, because what the government wants us to do is they want professional investors, okay? It's like, think about an amateur investor in oil and gas. What do they invest in? They invest in, you know, Exxon stock, right? They invest in stock. Well, do they get any tax benefits? No, they get nothing. But professional investors, they invest in the oil well. Well, that's what the government wants, and that's what they reward. They reward the professional. They reward the professional business owner. They reward the professional investor. As long as we're doing what the government wants, they're going to reward us. So going back to our question of deferral. See, an amateur, if you look over here, what do these guys get to do? They get the 401k, right? They get the IRA, right? They don't get, most of the tax benefits don't apply to them. They don't get business deductions, right? Now these guys can, but they'll get business deductions, but only if they behave professionally, right? They have their documentation, they have a good set of books, right? They have an accountant who makes sure that their tax returns right. The government, what does the government want? They want a balance sheet and an income statement. They don't want just a P&L on Schedule C. That's why you have 5 times greater chance of being audited on a Schedule C than you would if you were an S corporation or partnership. Why is that? Well, it's simply because you have a much greater chance of making mistakes. You're an amateur. Okay, so this whole idea that you work together and work as professionals is a key difference in the tax law. So you want to reduce your taxes. One of the keys is behave like professionals. Well, of course, one of the keys there is work with professionals like everybody on this call who understand. And I know I'm preaching to the choir here, but I want to give you a couple of examples of things that working together can do that I think are almost impossible to do if we don't work together. And I'm going to give you an example right here in the passive activity loss area. Most people, when they're doing income tax planning, and they have I'm going to use real estate here, okay, because this is just an example, okay? This could apply in any business, frankly. All right, but let's say you have a real estate investor, because we have a lot of estate planners, and they're going to have people that own a lot of real estate. Okay, and let's say that you got a passive, okay, well, it's going to be a passive activity loss because that business owner, right, that business owner's over here, right? I mean, that business owner is spending all their time, they're either going to be here or they're going to be here, right? They're not going to spend much time over here. So what's going to happen is that's going to be a passive activity loss, which means that it just carries forward forever until you sell the property, right? Or you have other, I mean, pretty much that's what happens with people. So what do people do? They spend all their time thinking about, well, I need to create, if I've got a passive activity loss, I need to convert that to active. And yeah, there's ways to do it. I mean, if your income's low enough, I don't think any of our clients, their income's under 100,000. Okay, or you or your spouse can be qualified as a real estate professional, and that's where all of the emphasis is. Okay, every time I go to a conference, that's the emphasis. But what if you did the opposite? What if you took an active income and you converted it to passive income? To passive income. Mm-hmm. So we always say pigs are our pals, right? So that's a pig, a passive income generator. So for example, this is where your kids come into play. See, I told you your kids were going to be an asset. You didn't believe me, Doug.
They're going to be happy about that.
Okay, so let's say we've got Doug here, okay, and Doug has a business. It's not his practice because it doesn't work with your practice. Well, we can actually get it to work with your practice. But let's say Doug here, we were talking before we started here, we were talking about your coin, right? Your intellectual property, right? Yep. So Doug has this, we're going to call it an S corporation, and the reason we're calling it S corporation is because we want to avoid Social Security taxes, which we would have on self-created intellectual property. Right. So we've got this little S corporation, this S corporation, not little, but we got this S corporation, and it's throwing off income. Well, Doug's involved in it. So for Doug, it's active income. Now, Doug also over here, Doug has real estate, okay? And he set this up, and Doug, I know your structure is even more complicated than this one. But you've got, at the minimum, you're right, you've got your LLCs, your property's owned by the LLCs, and you've got a holding company. You've got an LLC holding company over here, and you own that. Well, the challenge Doug has, of course, is that Doug is very involved in his business, and he's spending basically 95% of his time over here and maybe only 5% of his time over here. Well, that's obviously, that's obviously not going to qualify for a real estate professional. And his wife goes, yeah, Doug, I want to spend my time raising the kids and spending your money, and I've got my own job, right? So I'm not going to be a real estate professional. So Doug's got all these losses. All these losses are coming off because of depreciation, right? It's got losses coming off, but they're passive activity losses. Okay, so what do? It's like we're stuck, right? No, we're not. What we do is, this is where the estate planners come in, because what we do is we put, what's your oldest child's name, Doug?
Iman.
With an I?
Yep, I-M-A-N, Iman.
Iman, okay? What we're going to do is we're going to gift or sell. I mean, I know there's this estate planning, you're going to gift or sell. We're going to use trusts and all that kind of stuff, but I'm going to make this simple just for these purposes. And let's say we're going to take, let's say this loss is $100,000, okay? So we have, I'm going to make it green because I think it's a good thing. Okay, so we got a $100,000 loss here. From there, and let's say we got $200,000 of income over here.
Mm-hmm.
So if we gave Iman a 25% interest here, he'd get $50,000 of income there. And if we gave him a 50% interest over here, he'd get $50,000 of loss. Now, for Iman, that $50,000 right there is passive. It's not active. So what we've done is we've converted active income to passive income.
Right.
Well, here's the thing. This is a perfect example of where you have to have all three disciplines involved, okay? Because what do we have here? Right here, we have asset protection. This is asset protection. This is asset protection. What do we have here? This over here, this right here, that's estate planning.
Mm-hmm.
Okay? But this right here, that's income tax planning. So it's literally impossible to do this without this team in place. And this, I think, is the challenge and why people don't do it. That, first of all, they don't have nobody's actually thinking about, this way about it. But second of all, even if they did, who's going to drop these documents? Who's going to make this happen so that the estate planning happens? Because consider, let's say we leave out the estate planners. Great, Doug, you and I get on a call together and we go, look, we're going to set this up. It's going to be great. We're going to make sure, the Iman, he's going to be recognizing the income, and he's going to be recognizing the loss, and it's going to be good from an income tax standpoint. And you're going to set it up so that it's got trusts involved, so that there's no the asset protection is there. So you're going to make sure that he's protected from an asset protection standpoint. Okay, the only problem is that we completely mess up the estate planning, right, without the estate planner involved. Or let's say the estate planner goes and does this. The estate planner goes, well, typical estate planning, what do we want to do? What I hear all the time, and I'm not saying this all the time, but what I frequently hear is, well, we'd like to have Dad, so we want Doug to be taxed on the income because we want Dad's, because we're going to drain the income tax out of his estate, right? This is an estate planning initiative, right? But in this case, I don't want Dad taxed on the income. I want Iman taxed on the income. In fact, it's critical that this is a beneficiary defective trust from an income tax standpoint, okay? But I need help because I'm not an estate planner, okay? And Doug, I presume you need help because you're not an estate planner.
And I can tell you, Tom, that if the estate planners would add the income tax planning component, the motivation for the client to get it done and do the estate planning, and the level of complication that the plan will be, which means also the amount of work that's available for the attorney, goes up. And I can tell you, anytime you add tax planning, clients are like, wow, we just paid for my estate plan times 10 by doing this thing. And since no accountants are recommending this, they're just not. You know it, I know it, everybody in this call knows it. They're just reactive. They're doing tax preparation and basic tax planning. If you're the estate planner and you can bring this knowledge to a client, you are the hero, which is why I wanted this call to happen, because this is so critical. Half of our challenge is getting clients to act, getting them to actually get the job done.
So I'm gonna put Iman over here, okay? And he's gonna get a portion here. He's gonna portion here. And here's the way my experience with clients in estate planning. They're going, I'm going to be dead. I don't know that I want my kids to have a lot of money anyway. So I'm not overly concerned. I don't want the government to get it, but I could just give it to charity, and that would solve my estate tax issue, wouldn't it? Yep, it would. I can give it to my spouse, and then, you know, that's fine until he or she dies. And, you know, and then if the kids are young, yeah, I want to make sure they're taken care of. Good. Okay. But man, I'm only 40 years old. I'm not dying anytime soon. Right? But if you involve, now you take something like this and you're going, okay, I'm going to save $25,000 every year, 25K per year, and I'm building more real estate. So that 25K is only going to go up in savings. I'm going 25K, like you say, Doug. I mean, I paid for the estate tax with one idea.
Right.
Let me give you another one. Okay. Some of you are familiar with captive insurance companies. Okay. Now, the captive insurance company, as you know, is basically Doug has his business here. Now we're going to talk about your law firm. So Doug's got his law firm, and Doug's law firm has some. He wants to self-insure, but he doesn't really want. He doesn't want to pay for insurance because it would cost too much. So what he's going to do is go, I'd really like to set money aside, but wouldn't it be nice if I could set money aside and not have to pay tax on it? And that's where we do, and I'm just going to erase this one right here, and that's where we go, okay, well, Doug, we're going to have over here, we're going to have a captive insurance company, okay, which is going to be a C corporation. Okay, so what you're going to do is you're going to pay the C corporation a premium, and they're going to give you protection, basically. And then you're going to basically self-insure, and you've got this. Now, I know we've got, you know, it's now a disclosure item, etc. But this is actually something that I think more and more people will be doing, especially the wealthier clients, because they need the insurance. They want to set the money aside, and this is not just a tax strategy, okay? Well, as a lot of the estate planners on the call know, is that, well, what we were doing was, great, what we're going to do is we're going to have the captive owned by Junior, okay? Iman's going to own the captive. But when Senator Grassley, a couple of years ago, said, look, we're going to increase the amount of deduction we can get, and we're going to solidify this as a planning technique. When he did that, he also said, yeah, but whoever owns the business also has to own the captive. So then, you know, oh, so we can't get it out of the estate. Yeah, we can. Let's get him to own the business too. Okay, now, how do you go through and own the business? Well, that's where, first of all, I'm going, all right, Doug, let me see if I get this right. In your business, you probably have intellectual property, and you have clients, which are goodwill, right? And you have the actual services that you provide, right? That pretty much break it down?
Yeah, absolutely.
You probably actually have some other intellectual property that is your systems and all that kind of stuff. I know you've got a ton of intellectual property.
Right.
So you've got all this stuff, and you're going, well, my biggest risk in my business, it's not even my clients. My biggest risk is my employees. It's my biggest risk. So I know Doug's going to go, I don't want one S corporation. I want more than one entity because I want to split my risk. So I want an IP company over here. Great. Okay, well, is there the risk over here that I want to insure? Yeah, absolutely. So can we set this up so that while Iman may be prohibited from owning the practice, we could have Iman own other pieces of this, the IP, okay, there may be some equipment, there may be a few other things in there that Iman could actually own interest. He's not going to own interest there, right? But he is going to own interest over here. And now he can own a proportionate share of that captive. But see, all of this, it doesn't work unless you've got the estate planner involved, unless you've got the income tax planner involved, and you've got the asset protection planner involved, okay? Now, let me go just one more step, and I know we're getting to where we want to take some questions, Doug, but when we look at tax planning, what I'm hoping that people are starting to see is it is a big picture, okay? So we actually got such a big picture that we learned a lot many years ago that we could not do a tax strategy without people already having an investment strategy. So this is where if they're, I know you've got some financial planners involved, they're another key part of the team, okay? Whoever does the financial planning or wealth strategy. Now in our firm, we actually decided we were going to do the wealth strategy because we couldn't find people to do it, so we developed it ourselves. But we actually look at the whole plan. So we're looking at wealth, because if I don't know what you're investing in, how do I know what you're going to do? How do I know what, how to help you from a tax standpoint?
Right.
We have to look at tax. We have to look at asset protection, and we want to look at estate planning, and we want to look at all four of those at the same time, okay? Because that's, that is fundamentally, that's the big picture here. You got all those different pieces, but you've also got all those different players. So we look at a strategy, we kind of look at a strategy like this. We take everything, and this is actually our logo. We look at where are you today, and then what's your dream down the road, okay? Doesn't matter what it is, because guess what? If you're talking about, well, sure, okay, I better know what my dream is for that, okay? The tax I better know, because otherwise, how do I know how I'm going to save taxes? I better know from an asset protection standpoint, because if I don't understand what I'm going to do with my money, my dream, I don't know how big it's going to be. I don't know what I'm going to do with it. I know I want to control it, okay? I've never met a client who didn't want to control it, okay? I want to control it, but I want to get tax benefits out of it. I want to make sure that I control it, beyond the grave, right? Which involves these guys, right? Involves all the estate planners. So it's that strategy, that overall picture, that when you have people talking to each other, and Doug, when we work together, and we spend a lot of time on the phone with each other, making sure that we understand each portion of the strategy. We actually, what we do when we do a tax strategy, we actually draw the diagram. Then we send it to the asset protection attorney and say, okay, what needs to change from an asset protection standpoint? Then once we do that basic income tax planning, then the next person we have to bring in is the estate planner. Because without the estate planner, we don't know, okay, what's going to happen down here, right? What's going to happen once I've grown my wealth, and then I also need to know what's going to happen in the meantime. What happens if something happens to me? Okay, I want to make sure I'm protected. My kids are protected there. So that's where it all comes together. So I'm gonna kind of wrap up with one last thing, and that is this. One of the questions I always get is, are you conservative? Are you aggressive? Is your planning conservative, or is your planning aggressive?
That
you ever get that?
Oh yeah, that is exactly what people want to know, because they want to put you in a pigeonhole of, okay, this is where I'm comfortable.
Yeah, right, exactly. So I'm going to give you guys, and you're welcome to use this, okay? So not to publish, okay, it is trademarked, but I'm absolutely use it with your clients, okay, because it's fantastic. You'll see, it's great. So let's say this is the law, okay, and it can be the estate planning law, the asset protection law, or the tax law. For me, it's the tax law, okay? So in my world, I'm looking at, this is the tax law. This is the whole thing, right? So I look at some of my compatriots, not to name names, and this is how much they know of the tax law. Just a little tiny piece. They've never picked up the Internal Revenue Code in their life. They've never read a regulation. Okay, they use the Master Tax Guide if they, in a pinch, right? Or they Google it, right?
Right.
So here's what happens. Everything beyond what they know is aggressive. If you think of a somebody's racing cars, okay, yep. Indianapolis 500. My favorite, Danica Patrick, just because she's really cute. Okay, so you put somebody out there going 220 miles an hour, okay, racing the oval, Indianapolis 500. Okay, you put me out there, and it's dangerous. Now, if I were out there, that would be aggressive. But if Danica Patrick's out there, not aggressive at all. That's well within her level of experience and knowledge. Okay, completely different world. Now, what if, on the other hand, what you have is, what if you know this much of the tax law? Then what happens is, everything from here, this way, is conservative. So what I always explain to people is, my goal with our firm is to be the most conservative CPA firm in the world, because we know more. And to me, that's what makes something like Asset Protection Council great. And I know now I sound like a salesman, but I'm okay. I'm happy to pitch this. Is that you're increasing your level of knowledge, which decreases your client's risk. I mean, when you think about it, if you're an income tax if you're a tax advisor, CPA, and you don't understand estate planning, you have put your clients at risk. You've absolutely put your clients at risk. If you're a CPA, and you don't understand asset protection, you have put your clients at risk because you're not there to advise them. Okay, that look, you need to get so-and-so on your team. If you go back to our original diagram, and you say, what is the primary difference between the left side and the right side? And the answer is team. These guys have one, these ones don't. And that's the primary difference. Who's got the team? And like you say, Doug, if you're practicing one area of law, and I practice an area of law. I mean, I don't have to be a lawyer to do it. I have to be a CPA to do it. I practice an area of law. There's no question. I practice tax law. Okay, but if you practice one area of law and you don't have a team who can work with you on the other areas, and you don't have a fundamental understanding of what they're doing, okay, I run into a lot of attorneys who don't know anything about income tax. So when I get the chance to talk to attorneys about income tax, I'm all over it. Okay, I know even more CPAs who don't know anything about estate tax or asset protection. So when I get a chance to put a Doug Laudmill or a great estate planning attorney in front of CPAs, I'm going to do that because I want to make sure that at least my team of CPAs in our office, that we have these good, these really solid team members who understand that if they have this much knowledge, then they are very conservative, okay? And they can be conservative and still do great things for their clients. So, all right, Doug, I think we got a few minutes left. Any questions you've got or any questions come in, I'm happy to handle them.
I do have some questions, and I want to point out that the IP, in the example that you gave where we're breaking out the IP and how that creates a tax benefit, that's also exactly what we're doing all the time with asset protection. We're creating separate baskets that we're putting various assets in, which are based on the value of the asset and the risk. And if you do this right, as you and I know, Tom, working with clients, you're going to accomplish both objectives, or all the objectives, estate planning, the tax planning, and the asset protection in a better fashion by working together. So I hope
Right.
everybody
So,
is,
but what would happen, Doug, if you did the asset protection without the income tax plan? I will tell you, I've had it done to me. You would completely screw it up.
of
I mean,
course.
seriously, you're going to screw up the income tax because you're going to go say, this is great for asset protection. I'm going, yeah, but it's going to cost me hundreds of thousands of dollars in income tax. And the estate planning attorney over here is going, well, it may cost you a little bit of income tax, but it cost me millions in estate tax.
Right, which is why the having a team that actually understands this is so critical. And again, for a small client, you know, for the clients that don't even meet the estate tax exemption and have very small businesses, this is a little bit applicable. I think it is still applicable, and I don't want to take that level of client off the table because I think you still, it's for them, it's a big deal if we can save any amount. But as you go up the scale in the level of client, this becomes not just a good idea. This becomes critical. You should not be doing this work without the team in place, either bringing the team to the table, being part of the team, or being able to point to the right people that can be referred to be part of the team.
Well said.
Okay, so I'm going to invite everyone to ask some questions. You can just chat them in below, and while you're doing that, I'm going to launch a little poll here. We talked before, we want to know the answer to this question. So how many times a year do you speak to an average client? So just please answer. So, you know, multiple choice, almost never once planning is complete. I think a lot of estate planning attorneys, that's the answer. At least traditionally it's been. We did the estate plan, and, you know, I talk to estate planning attorneys all the time who don't even have the email of their clients, don't have it in a database. There's some other webinars where we talk about the power of being able to communicate with your clients on a regular basis. So, you know, this is old school if you're answering almost never. Once planning is complete, once a year is good. It's certainly better than nothing. 2 to 3 times a year is you know, you obviously have a relationship, you're doing something very strong with them, and quarterly or more. So please just answer the poll, put it in, and then I'll give you the results in just a minute. And in the meantime, I have a question from Mark Tom. He wants to know, I hope you'll talk more about the LLC taxed as a corporation and what the tax rate is. And I know why he's asking that, because as attorneys, we love LLCs for as asset protection purposes. As a member entity, it doesn't have the same risk associated with it. The shares of a corporation can be taken by a judge. A membership interest in an LLC cannot be taken in the same way. It's got limits on it. So it's a great question, Mark. Tom, how do you answer that?
So let me tell you, we actually have our own diagram for an LLC tax as a corporation. You know, we're very consistent in our diagrams when we draw our pictures for our clients. A triangle is a partnership or a disregarded LLC.
Yep.
A circle is an individual or trust, and a square is a corporation.
Okay.
An LLC tax is a corporation. We draw a triangle surrounded by a square.
Great.
Now, here's the key to understand. There is no such thing as a limited liability company in the tax law. Does not exist.
Right.
It is only a legal designation, which means that we can choose to tax an LLC any way we want. So an LLC can be taxed as a C corporation, it can be taxed as an S corporation, it can be taxed as a general partnership, it can be taxed as a limited partnership. It can be taxed as a sole proprietorship, disregarded entity. The only thing it can't be taxed as is a trust, but trusts are taxed as individuals, so it's all the same anyway. Okay, so so my point is that the answer to the question is, if for asset protection purposes it makes sense to be an LLC. Okay, and I know not all states it makes sense, but I know most states it does. Mm-hmm. If for asset protection purposes it makes sense to be an LLC, then that's great. Just make sure that the accountant makes the right tax election, because the last thing we want is, it's okay, by the way, to not make the election. If you don't make the election, then you're left with either a disregarded entity, okay, or a partnership. Mm-hmm. Those are not as harmful as making an election to be a corporation when you shouldn't be. So you can actually go back, by the way, you can go back and until you filed the tax return, you can make a retroactive S election. Okay, I know that the rule is, you know, the first, you know, 75 days, right? But but the IRS has been really, really clear that if you are acting like an S corporation and you file your return like an S corporation, you can go back, even if it's September, you can go back and get a retroactive S election, and they will give it to you. Okay, we've never been denied. So it's once you have the LLC, you can always go back. If you don't have the LLC, you can't go back because you don't have an entity to go back to.
Right, right.
So
Mark is sending in a clarification on it, saying he's actually asking for his business, income tax purposes for the attorney themselves business. So this is a personal question.
Typically you're, well, okay, I'm going to give you two options here, okay, because I don't know your situation, okay. The two ways to do it, if it's very simple, let's say it's just you and one other person and you're 50-50, okay. So you got Mark here and you got Steve over here, right, and they're 50-50. Then you're fine being an S corporation, right? You're going to want to be a flow-through. But let's say that not everything's 50-50, okay? And you don't want to be paying out salary because now you got Social Security taxes on salary. So here's what you do. I'll give you a really cool little structure, no additional charge, okay? Here's what I do. I do it like this. And this right here is the law firm, and it's a partnership. Mm-hmm. And this is an S corp. Steve owns his share of the law firm through an S corp, and Mark owns his share of a law firm through his S corp. And the reason I would do this is because from a tax standpoint, a partnership, for everything except self-employment tax purposes, a partnership is better than a corporation. For everything except, and I'm not talking about investors, et cetera, but everything from a tax standpoint, everything other than Social Security taxes, a partnership is better than an S corporation because we have flexibility in a partnership, okay? Just think about it. I mean, if you've got a corporation, what do you have to do? You got, I mean, in this case, everything's split 50-50. Distributions are 50-50. Mark had a great year, Steve had a bad year, doesn't matter, 50-50, unless we pay a salary, which is going to be subject to Social Security taxes. Whereas over here, we can break this up. We could have, we could actually have, if you look at this, you could actually have three different businesses down here, right? And we could allocate each of those businesses differently. Even though there's only one tax return, it's a partnership right here, we could allocate all of that differently. So I like partnerships. So if in doubt, I would be taxed as a partnership and then form an S corporation to own your share of the partnership. That's how everybody in my firm, everybody owns through an S corporation. Okay,
so
they own their share.
Piece that, for example, if Mark was a sole proprietor or just there was no partner, the answer would be S corp.
The answer would be S corp. It's 100%. Yeah, if you're a single owner, absolutely the answer is an S corp. It's only if you have another member in there that you might want to consider being taxed as a partnership, and then everybody has their own S corps.
Okay, great question, Mark, and I love the answer,
thank you.
Tom. Okay, so here's the answer to the poll, just so everybody has it. Kind of as I expected, a third is never, once, and then never. And the other third is once a year, and then the rest is more than that. So that's about right.
I got to tell you, Doug, I'm pretty impressed that over a quarter of them talk to a client. They talk to over a quarter of their clients more than 2 to 3 times a year. That's amazing.
Yeah.
I think that's impressive, actually. So.
Yeah, that's good. Okay, well, I'll ask one more question, and this is also a question we talked about. How often do you speak with your clients' CPAs? I know this question is near and dear to Tom's heart because that's what he wants to know. How, what is it? Have you ever, once, maybe in the beginning, annually, a lot, or you're really involved with the CPA? So I'm going to guess that it's going to come out, once is going to be the likely, and never. So
that's what I thought. That's actually, I mean, that's my experience unless I'm driving it.
Right. And again, as we know, if it's once or never, there's no coordination going on. There's nothing.
Right.
There's nothing that's really going to be coordinated, and that's not going to serve the client. Okay, let me give you the results to that. 60% once, never 10%. So that's good. Everybody on the call is mostly talking at least once, so that's great.
That's great.
Annually or more is 30%. So again, you guys, I think that's an outperformance. You guys are doing much better.
Outstanding. Outstanding.
Okay, well, I'm gonna keep this on time because I know everybody's super busy. Please, if you found this helpful, just type into the box. Just say, yes, this was great. I'm going to give you a way to get a hold of Tom. If you have clients that are need this, it is in your interest to find a way to get them to the right people. And Tom, how would you recommend someone on this call who's going, wow, this has changed my attitude towards this, interface with your firm?
Best way to get to us, I'll give you two places. Let's see. Okay, so either go to taxfreewealthadvisor.com. Okay, that's the website we use. That's my book. Tax-Free Wealth is the name of my book. Fortunately, a perennial has been at the top of its category on Amazon since before it came out, which is kind of fun. Or you can call us at 480-467-4400. So, feel free to call or if you go to taxfreewealthadvisor.com, we actually give a free chapter of the book, and the chapter is How to Find a Good Tax Advisor, chapter 23 of the book. So it's actually the most frequently asked question I get is, how do I find a good tax advisor?
Yeah.
And I encourage all of you to read the book, Tax-Free Wealth. I'd love to know what you think. Like I said, it's available on Amazon. It's available at Barnes & Noble. And I make like practically nothing on a book, so I'm not trying to sell books here, but I am trying to get the word out because it is a different way to look at income tax planning. I do have a chapter in there on estate plan. I'd love to get feedback on it. So if you get a chance, please shoot me a note on that. You can go to the contact on taxfreewealthadvisor.com. There's a way to contact us. I'd love to get feedback. So Thanks, Doug.
Great. And of course, you can also find Tom on assetprotectioncouncil.com.
There you go.
You'll see him there. Go to the member directory. You can find him there. I'll just read a couple of the questions and comments that are coming in. This is great. Is there any way to access this recorded program? Is this being recorded? So everybody wants the recording of this because we did cover a lot. It was a lot of information. Helpful. I would like to have had even more in depth. How can I listen to it again since it was recorded? So clearly everybody's interested in this. It is recorded, everyone. I will be publishing it at assetprotectioncouncil.com. I'll send you an email. You'll be able to watch it as much as you want. Share it with your colleagues, with your friends, with your advisors, with your clients. So this has been a great first Thursday for the Asset Protection Council. Tom, thank you again for being with us. I really appreciate it. Excellent presentation, and I look forward to having you back again, and we'll talk more.
Anytime. It's absolutely a pleasure to be with you, Doug, and with everybody on. Thank you for taking time out for this. It's been great.
Okay, thanks everybody. I will look forward to seeing you all next month. And remember, it's your money. Act like it. See you later.